Hello, everybody. Welcome to Optimal Minds, where we talk about everything finance and catch you up to speed in the latest news in the financial world. Today, we're going to see Willy Woo's views on chain analysis and what has changed. Make sure to like, comment, share, and subscribe. Don't forget to turn that bell notification on. And with that being said, guys, let's go straight into the video. In this interview, on-chain analyst Willy Woo talks about how on-chain data has changed and how we have to change our strategy, and how we analyze the data because the blockchain is always changing. He says that now it's not just on-chain data that we have to analyze, but also how the derivatives market, the ETFs, and futures contracts work with the on-chain data. In this interview, he also shares how the 4-year cycles are dead and how we might be in a lengthening cycle. He also says that we can expect a 100k Bitcoin by the end of 2022.
To answer your question, going into next year, it's I think one thing we're going to learn is that the 4-year cycles are dead, and then we'll probably have to decide whether it's lengthening cycles, which I don't think. Lengthening cycle, by the way, is like this idea that there's more and more weight in the system. So these oscillations of bull, bear start to be, bigger momentum in longer time frames, and maybe we won't learn that this year.
You don't think that's possible?
No, I don't think that it makes sense. I think that like on fundamentals, we have a 4-year gravity orbit around the halvening. So that's the mining infrastructure. So that's like one wave every 4 years, and then we have a macro cycle correlation, which is to traditional assets, which are like we have bull bear markets every is it 10 years or so? Roughly, it's kind of random. It could be up to 14 years. So that's another that's another sort of wave of like a decade-long cycle, and that's getting a gravity pull to the correlation to traditional assets. And then you have basic demand and supply of the like we had earlier this year was a lot of FOMO, and then that cooled off, and all of that FOMO and then cool off has its own cycle within our industry, which creates a wave of demand and supply, and that's different. So you have all these different waves on top of each other, and so I think that the main one is the halvening, and the other big one is correlation to traditional assets. So we're about to escape the gravity of the halvening, and we're going to enter a new orbit around traditional assets, and that is like a decade-long cycle, and so it's binary. I think it's binary, and we go from 4 years to a correlated asset to traditional, and we have little wavelets, which are our internal sort of infrastructure, like pulses, which are like, looking at this, it looks like every six or 8 months that's happening right now. So yeah, I think it's like binary. We go from 4 years to 10 years, and little wavelets on top of that.
How does this change how you analyze the data?
Mainly, it's the fundamental of what's going on underneath it, right? So like the price is like the result of all the pushes and pulls, and so it used to be very simple. It used to be just on chain, but now I have to understand how the derivative markets are working, how the ETF is like backing onto the CME on futures contracts. So it's really it goes beyond just on chain. It now needs really a good understanding of everything. I'm even needing to track corporate treasuries. Like now that like we've got this wave of public companies that own Bitcoin, they don't appear as whales anymore. They have to be known, public companies, and those coins are held by lots of different people. So it ultimately means I have to track a broader ecosystem to get any kind of reliable signal from the on-chain stuff. But the on-chain stuff still works. A lot of the indicators that were built early aren't so useful anymore, and now I really much rely on on-chain demand and supply, and that I work with Glassnode, and they do a lot around this thing called liquid supply, and that's a lot harder to fool as the whole ecosystem changes, because this is looking down into effectively the forensic history of investors, and you can actually, say this guy's a hodler, this guy's a trader, this guy's sort of a medium-term swing trader, and you can classify. Not you look at the address spaces, but we're not looking at addresses. We're then figuring out those addresses mean one individual investor based on the paths of transactions between it, and we're looking at individual investors as cohorts to go, okay, this is like the Michael Saylor guy. He's just stacking. And so if that guy that's stacking, very seldom sells, starts to unload his coins, we're in trouble. So in this cohort is like they'll buy, they'll sell, they'll swing traders over a certain period of time, and these guys are pure speculators. That they zero out all the time. So that kind of stuff becomes much more useful. And it's kind of a cat and mouse game, because so much of the blockchain has changed. So much of it has gone onto like derivative markets and so forth, that we're only capturing a certain part of it, and so that certain part has to be very, very accurate. And the data science behind it is now improved a lot.
In this part of the interview, he goes a little in depth about how Michael Saylor, individuals, and institutions alike might pose a risk to the Bitcoin price depending on their actions.
I think there's risk in it, because it's just one person that's the CEO of MicroStrategy that is in command of those coins. He's not the owner of those coins, he's in command of it. So, but I think if you were to break it down a bit, his course is set, because those coins again are not owned by him. Sure, he owns a lot of it because he's got a big majority stake in the company, but a lot of the coins that he owns aren't actually from the cash reserves of MicroStrategy. Some of it is from convertible bond offerings. So it's these kind of secondary derivative instruments that he's created, and they have terms and conditions on it. And so and those coins are effectively, you could say they're owned by other people. And so he's got to comply with that, what he's got on those contracts, which is effectively, I'm going to pay you this amount of interest, and if and you can convert into MicroStrategy shares at a certain point, which is effectively getting a claim on those Bitcoins. I think the whole plan screws up if he starts selling them. And it's a 5-year plan, right? But I think the course for MicroStrategy is set. It's going to be, you just blow up the company if you turned it the other way, even beyond Michael Saylor. It's a centralized entity that has, a governing, a few people that control it. So, it's not the most ideal. But having said that, I think people think it's MicroStrategy owning all these coins, and it's not. It's like a whole lot of unknown investors, and we cannot rule out, and I would say almost certainly, some of that Bitcoin exposure are other companies in the Fortune 500. But we don't know. It's a lot easier to say, I'm going to buy your bond offering. Thank you. Done. Sign. Don't have to figure out anything else like custody and whatnot. It's just easy. But they do this all the time. So